But otherwise, welcome, welcome. Many people are joining. Like I said, great time to put your LinkedIn handle in the chat where you're dialing in from. Maybe grab a glass of water. And you haven't missed anything. We will start soon. We will be recording this as well. Per usual, this will be available to members in resources under recorded programming. And for those of you who are not full members of the Fourth Effect, don't worry. We will be talking about that, and we'll be sharing some links. Okay, so Kat, let me know. I assume we are recording, and let me know when you want me to kick it off. I know people are still filtering in, but I know time is of the essence.
Yeah, I think we should probably get started.
Okay. Okay, well, with that, it is my pleasure to welcome each and every one of you to what we know will be a very insightful, valuable, and substantive conversation with William Lieberman, Kim Petrie, and Renee Wong of the CEO's Right Hand and his guests. So whether you are preparing for your first raise or you're refining your pitch for a new round, then this workshop, which is going to focus on building your investment case from the numbers to the narrative, will help you move beyond just the numbers and then shape that bigger narrative that really sticks and makes a difference. Before we dive in, before I hand the stage over to William Lieberman and to the team at CEO's Right Hand, just as promised, for those of you who are not already fully inside our community and our platform and really taking advantage of the Fourth Effect, I just want to remind everyone why you might want to start doing that. And this is because where our sweet spot is and the real value that we're bringing in the ecosystem that hasn't been there before, we're really helping pre-seed through Series A startups understand what fit for purpose advisory boards and governing boards are, like just kind of what that really means, what the strategy is around those boards, and how to leverage those boards to get money in the door directly, get money in the door indirectly, and scale and thrive as a startup. So because this information around advisory boards and governing boards, it's just, there's been a giant gap really in the landscape over the years. And I think that, I think there's a lot of economic reasons. I think there's a lot of reasons why that's the case, but things have changed. And now there is technology, and increasingly with AI, it's becoming much more practical that we can be that resource for all startups and give startups that competitive advantage that otherwise they're leaving on the table. And it really is a competitive advantage because most startup founders are not doing this. So if you are a startup founder, you're not fully taking advantage, please do. And we are very, very accessible to help you, to make sure that we're answering any questions or meeting you where you're at, or, if you come into our platform, you're not really sure how to get going or how to do it right. We are available every Friday from 12 p.m. to 1 p.m. at office hours. You can sign up under events in the platform. We also have platform tours twice a week, Mondays and Thursdays. We'll share the link. So it's a great idea. Come to one, come to more in order to get started, or even as part of onboarding. We offer a 30-day trial. So get started for free with full access to everything. Come to office hours, join the WhatsApp group, really start to dig in and see how we can help you as a founder get grounded and start to find value. And then also there's an investment club. So at the same time, you can post your fundraise, and we'll show you how you can connect your advisory board and governing board to your fundraise. So please come in and do that. And then on the other side of the marketplace, and sometimes you're a founder, you wear both hats, you can switch back and forth. If you want to go sit on those boards, you want to give back, you want to be a board advisor, you want to be a director, you want to be an angel and write a check, that is the other thing that's happening in our ecosystem and in our platform. So same thing for you. Start your 30-day trial. If you're not already doing this, come in, come meet with us, come to office hours. We'll really help you think through how you can get going and start doing this. So that's the plug. We shared all the links. Right now, there's around 1,000 companies. There's a little over 2,500 executives. There's around 300 in the investment club. So those are the stats. We'd love to have you really inside engaging and finding value if you're not doing it. Last thing I want to say is just that this is the third of 3 workshops in this series, and the series has been great. All of these 3 episodes have been recorded, and they're in resources recorded programming. This one will be there too. If you missed the first 2, we're going to drop some links into the chat so you can go see them. And so with that, let's get to the point of today, and let's hear this third part in the series. Let me now introduce William Lieberman. He's the founder and he's the managing partner of the CEO's Right Hand. William, let me give the stage to you so you can introduce your colleagues and you can introduce guests and get us started for today. Oh, I think you're muted.
There we go. Sorry about that. So thank you, Green, and great to be here again for the third part of the series. We've had a lot of interesting topics covered, and there's a lot more content today. If you have any questions along the way, please put them in the chat, and Mercedes, who's on, will monitor that and allow us to answer your questions as we go. So real quick about us, CEO's Right Hand, we're a sponsor for The Fourth Effect. We do strategic finance and HR for small and early stage growth businesses. We're based here in New York, but we have clients and staff throughout the country. And we have a whole bunch of different services that we offer, and specifically targeting how we can help early stage growth companies grow. And with that, I'm going to jump right into. We have our guests, Renee Wong, Chief Financial Officer. So Renee can introduce herself, and Laura's sitting in for Kim. So Laura will introduce herself. But Renee, just real quick about you for 30 seconds.
Hi, everyone. Very nice meeting you. So I have been a CFO in the startup space since 2012. Started off focusing on startups in the e-commerce marketplace side. My first startup is actually a unicorn called Fab.com that ultimately did not work out, but I did learn a lot from Series B to Series D fundraising and helped raise 300 billion plus. And that's my first foray into startups. And then over the years, I did a lot. I was CFO of like SaaS, and again, marketplace is my specialty. And in 2017, I actually fell into the crypto space, and I challenged myself to some frontier tech and also in fintech. And I did my first ICO of a fintech project, of crypto project in Hong Kong in 2017. And I've been in the space since. But I'm also now on the investor side. So I'm running a VC fund that focuses on investing in blockchain technology. It's a little bit niche, but I do have a lot of experience in both as an operator, CFO of early stage companies, as well as a fund that focuses on investing in pre-seed, seed projects. So I'd love to share my experiences, and please send in any questions. I would love to, help you through your journey, as I know it has a lot of ups and downs and very fun too.
Thank you. Laura.
Fantastic. Hi, everyone. I'm Laura Chun. I'm based in New York City. Every now and then you might see me glance out the window to look at the river and see what's happening. I've been with financial services and fintechs for the most of my career. I've most recently left a mid-sized company where I improved their revenue by 30% by driving the revenue, getting their technology in place and operations. And that really helped me get closer to investing and advising startups, because I found it very exciting to go from a large corporation, which is Goldman Sachs, for over 15 years, where I worked in their engineering division and drove a lot of strategic transformations, to going to smaller ones and finding my way to investing, which is very exciting. And one of my first investments was with The Fourth Effect as an equity member, because I really believe in the mission. And I made my third investment last week. So I'm extremely excited to be here.
Awesome. All right. So real quick, again, the links are available for the prior 2 sessions. It's all about what do you need to do to prepare for a capital raise. So we're not going to go through it all again, but please do go get those links and review them. And if you have any questions, reach out and we'll answer any questions that you might have coming out of those 2. And there's resources available and handouts and things like that that we provided. So if you need any of that, again, please just reach out. So the poll, and Mercedes will please launch this. You know, how are you confident in your ability to successfully close your next fundraising round? So yes, fully prepared, ready to go. Sorta, I need to hone my pitch, and nope, I need some help. So let's just do a quick poll and make sure everybody's had their coffee and ready to go.
Okay, we've got one vote.
We got 1 vote.
Only one so far.
All right, is everybody really paying attention? All right, let's go.
Can everyone see the poll? I just want to make sure, because I'm seeing some people mention maybe it needs to be resent.
We could just do it in the chat.
No, I
So-
Can
can't.
you click on it or just put it in the chat?
Yeah, just put it in the chat.
Put it in the
So-
chat.
We got 2 sortas. So
sorta.
yeah, and then we'll evaluate the chat and see how many came in for each of the options there. Thank you.
So what we want to do is talk through what's it take to get to a successful close, right? So we want to talk about the fundraising process. So we, again, in the prior sessions, we talked about how do you prepare? What information do you need? What's the financial model? What are the KPIs, financial infrastructure, all those types of things. But now we've sort of done that homework. And what do we need to do to really accelerate the process in terms of making sure that you get the information that you need to the right people in a way that they can make decisions, the investors can make a decision about, yes, this is the right thing for us, for our fund. So we're going to go through the fundraising process, and then we're going to talk a little bit about the types of instruments. And typically, companies in the early stage are using safes. So we're going to focus in on safes and what those are and how they work. And then we're going to go, okay, how do you negotiate? So you're sitting across the table from an investor. What do you do? And when they say this, what do you say? And all those types of things. So we're going to talk about negotiating and literally getting to that close for the best possible value for your business, best possible terms for that fundraising process. So we're going to start here with Laura walking us through the fundraising process.
Okay, thank you, William. And I see in the chat that Cricket and Tino are ready or prepared, and I know them, I met them, and I know that they are. So very excited about that. Let's go through the fundraising process. So there are a couple of key steps to really think about is 1, determine how much money you need, right? And think about it on the uses. Think about, is it for product development or is it for sales and marketing? I will say that as an investor, these are the key reasons why an investor will go in. Is like you would want to invest more on the product development side or sales and marketing to get more information about your product out into the broader marketplace, right? You want to be able to develop and test your marketing material, right? So that's your deck, your numbers, your forecast models, your cap tables. Test it out with individuals. A great way to do that is by leveraging your network, right? Ask friends, family. Sometimes friends and family can be your best critics. Sometimes they can really help you on those aspects. If you belong to professional organizations, that's another great area to tap into to test your network as well and test your pitch. As William mentioned, use safes, right? Your simple agreement for future equity. Unless you're further along in your company investment, safes are going to be the ones that is going to be the model that you're going to be using most. And if you have multiple investors, our advice to you is go for the lead investor first, right? Because typically, if you can get a good, strong lead investor, that will make it easier to get other investors along the way because they all say, oh, you happen to have this investor. Very interesting. The others will be much more open to following very quickly on that. The other advantage of focusing on getting your lead investor is it gives you that practice, and it gives you the opportunity to hear any objections and feedback to be able to refine and hone your pitch. Okay.
Hey, Laura, quick question. Is it your opinion that people need more than one investor?
It depends on how big that dog is for the first one that you capture, right? And you have to also think about the overall, and we'll go into this later, the overall makeup, William, of what you are looking for in an investor, right? If you are looking for specific skill sets to help bounce off your ideas or to provide, you always have to think about the long game. You're not looking for someone for just a year or two. You're looking for several years. So you may need more than one investor. You may find one investor that has everything that you need for not only the immediate term, but for the long term as well. So it completely depends.
Gotcha.
Great. So when you're managing investor conversations, there are 5 key things I want you guys to kind of think about. We put them into pillars. So one is evaluation and dilution. So when you're raising capital, this is going to be very critical because it's going to affect both your company's future, but as well as your ownership stake in the company. So one key thing is really ensuring that you have an accurate company valuation. Right. If you think about, for those of you who are already prepared and speaking to investors, one of the top questions they will always ask you is, how did you come up with that valuation? Right. So this is going to be really key to have this bulletproof. Right. You also want to think about your dilution mechanics. All right. So how many investment rounds are you going to have is going to affect the amount of ownership you're going to have for not only yourself, any employees that you have from the very onset that you might have given shares to, and your existing investors. So what you really want to do is think about using modeling tools for your cap table, right? The other thing too is think about your anti-dilution provisions, right? Anti-dilution provisions protect the investors, right? But it will affect your stake down in later rounds. So really make sure that you're thinking about that and factor in option pools. So think about how creating or expanding employee options is going to affect your overall dilution. Okay. I see a question from Andrea. I can pause in between. So what about a safe when valuation isn't discussed much? Andrea, can you expand a bit more on that question?
Hi, can you hear me?
Yes.
Isn't it when you're doing a safe, like at a pre-seed round, it kind of kicks the valuation conversation further down the road?
Yes.
So if in
Exactly.
that case, then what would you have? How would you have that conversation if valuation's not considered at that point?
So for SAVE, and it's okay if I take
Yeah.
this question.
Mhm.
So for SAVE is basically an agreement, right, to promise a future amount of equity
Right.
at a certain valuation. There has to be a price round, a price in mind. You can say, my first SAVE is at 10 million valuation, and I'm raising 1 million, and I can give you a certain discount. You can later on do another SAVE with the company further ahead, have made progress, and have another SAVE at 20 million, right? And I have another pre-seed SAVE 2 round that has a higher valuation that reflects the progress. But now, like an open valuation SAVE, typically now investors don't go for it.
Okay. So they want like a valuation cap with the discount?
Or discount is up to you if you want to give
Okay.
a discount or not, but it's typical at an early stage to give a discount. Yes.
Okay. Thanks.
And
Renee?
oh, sorry, I just had a follow-on question on that topic. If because that one thing that comes up a lot, the world has changed dramatically in the last however many years. So the valuations on safes, post-money safes, pre-money safes, they were very high for a while, like 2020 through 2022, sometimes like 60 million, and is basically an idea. What do founders do if they don't want a down round but they're still raising on safes, but they had higher valuations because things were frothier, and then now valuations have all come down. What do you, and sorry if this is outside the purview of this, but I was just wondering if you have a recommendation for how a founder thinks about that. Like, is it that they're doing side deals like with discounts, or like how are they making up for that?
So just want to make sure I understand. So the company's raised multiple rounds already, and the last round, let's say, is at 50 million, and it's at a safe. Okay, and then you already get investment in at 50 million. Now the company, you think you can only raise it at 30. Is that correct? Yeah. So but you don't want to say you're raising a pre-seed, a fourth round of save at 30 million, which has a down round valuation. Yeah, I think you need to give discounts. Yes.
Okay.
I think that's the easiest and cleanest way. But like another thing to caution about saves is you can do maybe 2 or 3 rounds of save, and at that point you actually have to do a price round. And I'm this is based on my personal experience. You should definitely talk to counsel, but typically counsel would say after 3 rounds of save, you should really invest in doing a price round and actually close that round. Yeah.
Okay, Laura.
Right.
Keep going. I don't know if you're going to be able to hit all of these, but sort of
No,
hit
I think
the high notes.
the high notes is think about your turns, because this can really have really far-reaching consequences. You can't go back and modify your terms like when you go for your first investor. So ensure you think about your liquidation preferences. The key thing I want to pop out is really your protective provisions, right? Review which company decisions are going to require investor approval, right? You need to understand how much, negotiate this very carefully, because you do want to make sure that if it does require investor approval, you are going to be losing some control that you have in directing your company. So think about that aspect. Investor fit, think about bringing on the right investors. It's very attractive to be able to get money from individuals, to be able to see your vision through. But make sure that the investor you pick is aligned to where you want to go. They share your values. They have a track record for investment, right? Also think about the follow-on potential, right? Ability to also fund you further down the line as well. And reputation. As Breen was saying, the market's changing very quickly, right? Reputation is going to be very critical. So do your research on the investors that you are going for. Operational readiness. I'm not going to go too much in detail on this, because the first 2 sessions, we spent quite a bit of time on this, on operational readiness. But these are some of the key things that you should be looking at. And then process management, right? I'm all about process, right? Make sure you have your timeline in place. And when you're thinking about your timeline, consider the fact that summer holidays, year-end holidays, people are busy. So you really want to make sure you're taking into consideration timeframes as you're going through. Think about making sure that you have a way to manage your pipeline of investors, keep them on track. Data room preparation is key as well. That's when I hear many founders spending a lot of time cleaning up their deal room. It's not a one-time you're done. So hygiene is good for that. Refine your pitch, right? Negotiation strategy. Keep in mind as you're going in, know exactly what you're willing to give up and what your non-negotiables are, right? And make sure that you really think about how you're going to coordinate all the closings that you're going to go through. Okay. Great. So managing investor conversations, there's about steps. There's 6 key steps. The first 3, think about create, manage, and prepare. For create your timeline for when you're going to reach your investors, right? Think about the momentum that you need to build, right? Manage your communication, right? Track every interaction you have with the people you're speaking with. Ensure that you're following up with them, right? Personalizing conversations, especially when you're going at this early stage. The more personal you can make the conversations and tie it into previous interactions, the better, because you're building relationships, right? They're buying you and the company, right? And balance your persistence with professionalism. What we mean by that is it's always maintain a sense of you're a business owner, you're selling your company. Make sure that you're being persistent, but not too persistent. You don't want to be that salesperson people want to hang up on all the time. And prepare. This is an emotional roller coaster. Many of you have been through this aspect before. Some of you first-time founders. There are going to be a lot of highs. There's going to be lows. Sometimes you're going to feel more lows. So really practice on how to have a thick skin, how to handle the common objections that are going to come from investors. Try not to take it personally. All right. I know you spend a lot of time, blood, sweat, and tears, and this is your baby. But try not to be offended if someone says this is an ugly baby. It's not an ugly baby, right? Think of ways to come around that, right? Know when to push back, and know when, and because sometimes when investors ask you questions, especially what you might feel is hard questions, they're not necessarily questioning you. What they're really wanting to do is they're questioning your thought process. They want to understand what your thought process is, how you're thinking, right? And how you will handle these objections that go through. And feedback is a gift. Objections are a gift, right? Take it as that. Take it as a way of saying, this is a great way for you to strengthen your pitch, maybe modify it a bit. And maybe it's a way to tweak your product as well. All right. So again, key message, thick skin, don't take it personally. Okay. Next slide. Navigate, identify, and catalyze. Right. I talked about this earlier. It's the roller coaster. Confidence is a hard thing to build. All right. Try to maintain your confidence. A lot of this is creating a tribe of people that you know. If your investors are a great place as well. All right. The investors that you have that have believed in you along the way. The fourth effect is a great, as I do a plug for the fourth effect. The fourth effect is another great place. Build a community with someone who's going to help you navigate this aspect. And sometimes you just need to take a breath. Step away, take a breath, come back to look at it. Right. Second, identify your serious investors. Right. There are people that are going to be out there that are just what we say, they're kicking the tires. They're experimenting, they're angel investing for the first time. Try to separate those from the real investors. Focus your time and your energy on them, right? Also know when's the time to move on, right? And then catalyze. This piece is really about how do you help create this sense of urgency for investors to try to get them to close along the way. Think about strategic updates. Right, to be able to help keep them engaged along the way and keep them moving along as we go through and develop the momentum.
Awesome, Laura. We do have a question from Shweta Mokashi. What are the ways to measure for AI native companies to understand its accurate valuation? Do you need to expand on that?
Yeah.
Hi, this is Shweta. Thank you so much for taking the time here. I have a company which basically provides founders with understanding their gaps. So it's a AI analysis that we do of not just the pitch deck, but we also collect information from Carta, Crunchbase, whatnot, right? So in such cases where we do have certain clients, how do you measure the value of a company providing that kind of services, which is primarily AI data? You know, these are AI LLMs, customized LLMs that we built.
Renee, you want to take a stab at that one?
So you are asking how you value your company that is mostly AI driven?
Yes.
I think I will look at comparable, like any other professional services company that are LLMs that's popping up left and right. And I will hone in, right? You are like, is it more professional services LLM, like more from a legal point of view? Or like I'll break down your product offering and then try find comps in each area of the product offering. And so you have like a set of that, like evaluation data, and then you see where you fit in it.
Got it. Thank you.
Yeah, there's a great resource, angel.co, C-O, and you can go on there and query all the deals that have got done at a particular stage in a particular industry vertical, and it'll tell you the valuation. So that's a really good resource for startup and early stage growth companies to look at for valuation data.
Yeah.
Perfect.
But
Thank you so much.
who, like, you gotta have some competitors too, right? I mean, that's one question that any investor would ask. Who are your comps? Who are your investor? Like,
So
you,
we're basically providing a term sheet for startup founders to understand their gaps. So the only company that I'm aware of that's doing that for founders, I mean, internally VC firms do that for themselves, take inbound and run analysis, but Flybridge is probably one that comes to mind right now.
Yeah.
Sorry. Yeah. So that's one, and then there are a few others that are still budding up, but not really as much competition right now, at least to my understanding. Yeah.
Yeah, one last comment on this, like, because AI, like, it's tough to really find a good comparison. I would actually look at a Web2 company that will like do similar things and try to tag on an AI premium to it.
Got it.
I would agree with that, Renee. This is all going to be extremely new, so any valuation is going to be a guesstimate until the company's mature and you can actually get a more accurate valuation. So I would agree with Renee's comment.
Thank you all so much. This is really helpful.
Well,
Okay.
and one other or clarifying kind of question or point is just, I know depending on the round you're at, if it's pre-seed, if it's seed, like looking at comparables, what percentage overall stake in the company should you be giving away in that round? And then you can kind of work backwards a little bit from, if I'm raising 2 million, but I should only be committing no more than 12% of the company, then what is that bigger valuation? Like maybe you're raising to 1 million, and then that's that 12 to 15% range. But I know that there's some great resources out there about like how much equity should end up being given away in a pre-seed round or in a seed round, and you want to stay cognizant of that so you don't end up like giving away 40% of the company in a pre-seed round.
Oh, absolutely. Dilution is going to be the key. Yeah.
All right, let's go to the next section, and Renee's going to talk a little bit about term sheets, and again, focusing in on safes, because that's really where early stage companies should be focusing their time and energy on the fundraising process as the instrument of choice.
Yeah. So what's a term sheet? Is basically your agreement with an investor, and the agreement has like the price you're buying your company at, how much are their ownership of it, and then as well as a lot of the, in a very simplistic sense, right? Your ownership of a company, and then there are a lot of other criteria you usually consider, which is do you give them a board seat? What are some liquidation preferences? So it could go very complex if you do a round that is we call a price round. And a price round is actually getting lawyers. You need a counsel to have multiple investors and actually going through the actual signing off the shares at a valuation that they all agreed on. And when we keep on talking about lead investor, a price round typically is a larger round, so you raise a larger amount of money, and you need someone to lead that round to pull together. So typically it's definitely more than one or two investors in that round, and then it is a more costly process that you use counsel. And costly, I'm talking about at least $30,000 to $50,000 of legal fees to pull it together. And also it requires much deeper due diligence. So it will go through like, besides all the information and the background of the investors, is going deep to all the asset liabilities and also all any kind of regulatory issues of the company. So you have to devote also a lot of attention and resources to close a price round. So let's move on to that. And then what is a SAFE? So SAFE comes out to be is widely used for the pre-seed C stage company. during the fundraising process. And it's not a price round in the sense that it's just an agreement between you and the investor on a price and on how much ownership they will get. And then this agreement that by the time you actually do a price round, you will get this ownership. So this is the step before a price round. And the advantages is that it can be rolling. So you don't have to have like 3 months to close this round. It can be ongoing. It is a valuation that, as long as you and the investor agree, and typically it doesn't require a lot of due diligence. And also you don't need a lead investor in a safe. So that will help a lot in actually closing the deal. You can actually close the deal in a couple of days if you have an investor in mind. And then also it's very different from like a convertible note saying that, oh, at a certain date when there's price round, you get this share. And in the meantime, there will be interest the company needs to pay, with a loan agreement attached to the equity. This is not it. This doesn't actually have the convertible note a component to it. So this is a much easier agreement and transaction to make. And quickly, what are the few variables, I guess, you need to decide when you go into a save and talking to investor? A is the valuation cap, which is what you value the company at. And typically, investor like companies will give the early stage investor a discount rate. So say that I'm valuing my company today at $15 million, but because you are my first couple of investor, I'll give you a discount at 20%. So you are actually investing in a company at 15% at 20% of $15 million. And then you can decide, right, how much you want to raise, this round at. But it can be rolling, right? So maybe you first just want to raise 500K at this 50 million at a 20% discount. But later on, as the company also has made more progress and you also see that you need more money to grow the company, you can do it later on at a higher valuation and and at a different discount rate. And conversion trigger events is what will actually convert it into a real round, right? A real percentage, and you actually get a share certificate. Is when a company through an actual price round, or in the meantime, if a company gets acquired. So we call that a liquidity event, is when a company gets acquired or a company goes IPO, which when at such early stage is very highly unlikely. So is when the company gets acquired. And as I mentioned, it's cheaper, is very flexible. You can do a couple of save rounds. You don't need a lead investor, and is also widely known in the VC institutional investor circle. So you don't have it's pretty standardized, the paperwork. So you don't need to pay a lot of for a lot of legal costs to go over that agreement. Next slide, please.
Okay, so from here, what do we do in order to actually get the deal over the finish line, right? So what are the strategies? You're sitting across the table from one or hopefully multiple investors. What do you need to think about in order to get that deal done? And, we like to say you are in the driver's seat. Of course, you're looking for them to make a decision, but you control the process. Yes, you cannot control their decision, but you're in the driver's seat in terms of the process, and you can impact, obviously, their decision making. And so we want to talk a little bit about that. So Laura, why don't you start here?
Sorry, Laura, before we get started on closing the deal, we do have a question from Pooja. Are investors using custom-built or licensed GPT tools to evaluate opportunities? And has the due diligence process changed since the use of GPT tools?
I mean, I look at deals all the time and I don't rely on GPT tools. I mean, I don't in the sense that, I may help with some research, But like if you're deep in the space, you kind of get a sense of what the valuation of projects. The where I would use some of the AI tools is actually helping with the legal side to just, get a first preview or like run up some like of the legal documents and make sure I'm not missing anything before I go to counsel. Because, attorney fees these days are very expensive and you can really run up the tab. So I would use those tools more on the, going through legal documents, doing some due diligence, but no.
Mhm.
And maybe I should rely on it more, but I don't use it as much.
Right. And so exactly for that point, PEs and VCs are using AI more frequently, whether it's, open sourced or whether it's something, some of them build their own custom built ways, but they're using it to do exactly what Renee said. It's the standard research aspects, going through the legal documents, going through terms, reviewing that. Generative AI is actually quite good at looking at unstructured data. So if you think about things like customer reviews, scanning social media and understanding, what's the hit rate on this aspect? How are people responding to it? So collecting all that information into one place makes it easier, right? But the one key thing behind all this is that for anything that AI is doing right now, you still need that human in the loop. You still need that wise investor to look at all the data that it's collecting to be able to make that final decision on whether or not they should invest. And then the other piece, just another thing that I know that VCs and PEs are doing with it is instead of looking retroactively at the amount of money that's being raised or that's being used, they're also using it to do more predictive analysis. Right? Being able to create the models of, well, if revenue went this way or cost went this way, what could be my way to get out earlier? What are the different levers that could be pulled? So a lot of that data crunching it's being utilized for.
Okay. All right, Laura, why don't you hop into closing the deal?
Close a deal. Okay, I'm all about prep, right? So definitely know your metrics, right? Understand your best alternative for that negotiated agreement. Like what you'll go in for what you have in mind, but what are you willing to give up along the way if they don't accept your original deal? Do your research, right? Model the multiple cap table scenarios, right? Showing safe conversions. This is one of the most complicated aspects. This is where I would call William and say, William, can you help me with this cap table scenarios? This is very complex, and that's where I would call in experts. So I'd say as you do your pre-negotiation prep, just like I said in the first call, know when to ask for help. You don't have to be an expert in everything, right? Leverage the help, and it's going to save you a lot more time and costs and pain down the road, right? And then set clear minimum targets for what you're trying to raise. Have those ideas in mind. Next slide. Great. Initial outreach. So perfect your concise, compelling pitch, right? I see a pitch deck that's more than, this has 12 slides, but if I see it has more than 12 slides, I will not look at it, right? An investor probably spends 1 to 3 minutes on a deck, right? So it's got to be crisp. This is prepare and practice. A great way to practice. Sometimes these pitches are being done through calls. Record yourself. Technology is great. Record yourself going through the pitch. It's going to be hard, but watch yourself. I think that's a great way to do it. Right? Be strategic about your meetings. Plan it out. Think about your friendly investors first. And we talked about that emotional roller coaster. Mixing your tough people with your not so tough people along the way. Right? You're feeling a little low. Call that friendly person that you know, just to manage that confidence along the way. And momentum is going to be key, right? So work on the outreach, go in parallel conversations, right? You don't have to go sequential. Sequential is a kiss of death, right? Next slide. Meeting. This is the first one because this is the one I truly believe in. It's treat these meetings as a two-way evaluation, right? they're evaluating you as to whether or not they want to invest in you and your company. But you know what? You also should be evaluating them as well. And I have met some founders who have walked away from investors before because they said, you know what? They aren't the right investor for me. They have the money, they're willing to sign a check, but it's not the right fit for us down the road. Right? Follow up with specific updates, right? Say, okay, I'll follow up with you in 2 weeks time. And if you say you're going to follow up with XYZ in 2 weeks, you have got to follow up in 2 weeks. Okay, because part of what you're doing and what investors looking for is credibility. You're establishing trust. And the best way to establish trust is by doing what you say you will do. Okay. Recognize that signal of genuine interest or polite engagement. Right. There are, believe it or not, there are, especially when you go with an angel investor, there are polite people, and they may not want to tell you they're not interested. Right. Try to discern that so that you're spending your time and your energy on the people that will invest. Right. And come prepared with your common objections. And as I said earlier, set clear steps.
Perfect. All right, Renee, I'm going to hand it to you to talk about terms.
Yeah, so you have an evaluation of a company in mind, right? Let's say I want to raise my company to 20 million. I want to raise 2 million out of 20. And I'm giving the first 5 investor 20% discount. First, like after talking, you need to kiss a lot of frogs and find a prince. So after the first 10, 20 investors, you'll get a sense, is that valuation reasonable? And how hot your startup is. Is there a heat to it, right? We call it, and so let investors present their standard terms, and typically is not, if it's a safe, there's not really that much to negotiate it. Is that the valuation or pretty much the discount rate? And then, if you really want investors, and I want to echo Laura's point about finding the right investor. Early stage, your network is very important, and who you bring to the table is very, very important. Do you want just money, or is it money with hair on it? Or you also want strategic partnership that can open doors for you in the future? I strongly believe you want true partners and who really believe in the mission and be with you throughout the growth process of the company. So that's one thing to keep in mind in terms of finding the right investors and agreeing to the standard terms. And typically, if it's an investor in your space, you will know that what is reasonable and not reasonable. And of course, don't be desperate. Be really discerning, because they will be right with you throughout the journey. And then, the key safe terms is valuation cap and discount rate. And if you definitely have to be very responsive. You have to be on it. And honestly, if it's a term sheet you want, is someone you really want to partner with you, then I think there's no reason even to wait, in my opinion. I usually am very proactive in jumping onto deals. And also always have a pipeline of investors talking, and think long term, right? This is not like, yes, you want to close this round, but sometimes it might not be a fit for now, but it could be a fit for the next round. So always keep conversations going. And they also have a lot of friends. VCs, we pretty much all know each other in a way, right? If we don't have 1 degree, we have 2 degrees of separation. So if they are not a fit today, they might have friends, another VC friends who might be a good fit for you, or they could recommend either marketing people or from different executives who can help you in the process. So always have a lot of parallel discussions, and keep growing the network. And you definitely have to make sure you need to talk to managing partners, because typically VCs will have an investment committee that they will present your case or the project, and a lot of them need majority vote. So the more like key people you can meet, the better, who can champion your project and your investment. Yeah, next slide, please. And then, yes, like you have to, ideally, set a date and say, we want to close this round by this. We don't, and the line that most entrepreneurs use is that we want to put our energy and fundraising back to operating a company. We don't want to drag this around for too long. So we are going to close this round by end of the month, and or if there's a certain operation thing that you want to do, that's why we want to close this round. So create this sense of urgency that you want to close. And ideally, you say there are already 2 or 3 checks out there that is, that will kind of make up the round. So, is oversubscribed. And so please jump in if you're really interested. And we are making room for you, right? Those are some of the lines that most entrepreneurs use. And yeah, like determine your minimum viable investor cohort. Is like the group of investors that you think are, you really want to be part of your company and will write checks. And again, the templates is, I will say, go have one save that you're going to use, have a template, and have counsel just for 30 minutes to review that template, and then use that template over and over again with different investors, so, which will save you a lot of time and money. And then, yes, and from a logistics standpoint, just have a PDF with all your bank wiring information set up. And also for every investor, make sure you have the accountant or the finance person information, so they can you can verify with them when you receive the funds. And yes, always document all the all the communication with the investors, so that you can always look back. And again, build a database of investors and keep good notes even for future reference. And then afterwards is, I think good practice is at least every quarter, you should send an investment update, and ideally always lead with some progress the company has made. And then also whatever you will need for the company, add that to the email. Like, I think a good format to communicate with investors is progress today, any wins, any challenges, and where you can get their help will be a typical format in terms of investor communications. And yeah, and again, like, maintaining all the documents, maintaining cap table, because one thing is always keep cap table up to date, because every fund needs to do audit at the end of the year, and they will ask for the updated cap table on file, and also will ask you for audit confirmation. So you need to make sure as a company, keep good record, and also be ready to sign audit confirmations sent by the auditors. And then, yes, then you have to go over the whole process again, which is, I mean, I think by the time you have 50 to 70% of your working capital has been used. And the metric I use is, if you have 6 to 9 months of runways, start fundraising, because the fundraising process typically takes 3 to 6 months.
All right.
Renee and William, before we go into the key takeaways and summary, Breen, did Renee answer your question? She addressed parallel conversations, or did you want her to expand a little bit more on what those practical tips are and how to do that?
Yeah, I just thought maybe Laura or Renee, both of you mentioned it, and I think it's a great point. And I was just wondering if you had like super pragmatic, like, I don't know, like how to create an investor Calendly, and like what the cadence should be, and how many, like, I don't know if you had any tips or recommendations.
Being extremely organized. I mean, you can use Calendly's not my scheduling of choice. You can use things like Salesforce. I know that comes with costs, but it's really more around, once you snag your big investor, you have at least maybe 4 to 5. I'm just throwing that number out. People don't say it has to be 4, but just you have a couple other investors that you have. you don't have to wait until the second one, the conversation's done, and then the third one's done, is what I meant, right? You should be able to have multiple investors at different stages, right, of what you're having the conversation. And that's where tracking is going to be important. What was the last conversation I had with Laura? What was the last conversation I had with Renee? What were the follow-ups for that, right? And in
You
some
can use
cases, it's going to be different.
like a simple CRM,
Mhm.
just like a sales CRM. You have an investor CRM, same thing.
Yeah.
That's why I said Salesforce is one that comes with cost. It could be green, it could be an Excel spreadsheet,
Mm-hmm.
right? I mean, I use something very simple, Excel spreadsheet, and just saying what was my last contact list along the way.
All right, we got a couple more minutes, so let me just wrap up real quick, and then if there's a final question, we can grab it. So key takeaways, right? So you're building relationships with investors all along the way, especially as Renee mentioned, because you might be going back to them for more money, or they might not be a fit for this round, right? Understand your priorities, and does that match with the investors in strategy? And do you have the right fit? Again, that's putting you back in the driver's seat. Make sure you have all the control elements in place. Don't rush through the decisions, but you want to create the sense of urgency on the investor side, but you're not rushed on your side. Make sure you watch out for off-market terms. Off-market terms would be something where somebody comes, an investor says, hey, we want, 3x liquidation preference, or something that's just off market, and an attorney or CFO can help you figure out if something's coming at you on a term sheet doesn't make sense for where the current market sits. And again, make sure you get outside advice all along the way. So those are the main sort of takeaways from this. We have some resources. Again, we're sending out the deck. Y Combinator is a great resource. Again, if you're using safes, there's a whole bunch of great resources on Y Combinator. We have an article that we will send out. It's how to negotiate your first term sheet. If you want to practice, happy to have a 30-minute call with anybody from Fourth Effect. So just reach out to me and I'll get on a call. And of course, the Fourth Effect has a lot of resources available online.
If there is one message I want to share with early entrepreneurs, is investment is a people business, right? I have, especially in the pre-seed stage and seed stage, the concept is good, the business makes sense. Chances are you have a little bit of traction, not a lot of traction. And a lot of investors look at it as like, is this an entrepreneur I'll put money behind? That drives most of our decision. Does he know what he or she is talking about? Of course. Does she have a smart enough team behind him as a leader? And can he or she pivot? Because chances are, this business by Series B, it will be a totally different business. Mm-hmm. So again, always spend the time to build a strong network and see that network as your potential advisors too, right? If they're not investors, it could be your advisors. And keep on growing, and chances are the money that comes in are people who referred you or you have met with them and have a good rapport. So that's my major takeaway.
Exactly.
I think Cricket raised your hand with a question.
I've heard a lot lately. I've talked to a lot of people that there is no more pre-seed money, that the entrepreneur has to get to revenue on their own. And so I know there's exception for young men with games and so forth, but can you guys address that really quickly?
I think the criteria for us as a pre-seed is with a lot of ChatGPT, all these tools out there, is not hard to launch something. So have a concept is not good enough, right? In terms of there's no pre-seed money. I would like to see the technology at least in action. Now, whether it is able to get revenue yet or have proof point as a product market fit, not necessarily, but I do think that having the product launch is important.
So the active website and the photography, the branding and all that, if that's in place, then that's really what you're saying. You need to get it to
Yeah,
that.
or at least get some beta users. Maybe they're not like
Exactly.
getting through revenue, but at least someone using it so we can see that there is like utility, right? It's getting used.
Okay.
I don't think there's not pre-seed money per se. It's more of the fact you're going to have to work a little bit harder to have, as Renee said, a beta.
Okay.
Right? And it really goes back into being more thoughtful about, as an investor, who are you going to be building a relationship with? Which owners do you believe in? Which founders do you believe in?
Okay, great. Thank you so much. I'd love to talk to you guys. So I'll reach out later. Thank you so much.
Absolutely. Andrea had a question about KPIs. Do they depend on categories, SaaS versus CPG? Absolutely. So there are definite KPIs that are specific to each industry vertical. SaaS, it could be CAC, customer acquisition cost, lifetime value, monthly, recurring revenue, etc. CPG could be average order value, things like that. So absolutely, there are KPIs.
And
Very.
Can I just ask a quick question? When Cricket was talking about pre-seed and money not being there in the pre-seed round, and you had mentioned, well, as long as you have a beta product or customers testing it, that might be more for a SaaS versus a CPG where you do expect revenue coming in before investment, or no?
So the question, let me see if I repeat it. Can you get pre-seed money for a CPG business? And if so, what do you need to have? What traction do you need to have in place? Is that the question?
Correct. Versus like beta testers. Yeah.
Like CPG as in an actual product or like a marketplace? Well, I mean, CPG, I advise a couple of them, and typically they fundraise after having put it on Kickstarter or able to get some pre-sale to show some track record.
Okay.
So you got to have some traction. You have to have some traction, even with a CPG.
Yeah.
Okay, thanks.
All right. Anybody else? Any other questions? Thank you so much. I know we ran a little bit over, but thank you all. Thank you, Fourth Effect, Breen and Kat, for helping organize, and thank you, Renee and Laura, for being great panelists, and Mercedes for helping organize everything. Super helpful.
Thank you, everyone.
Thank you. This was really valuable. So really appreciate it.
Bye.
Thank you all.
William. You Green. Kat.
Hey, Tina.
Hey, there were four things that I had in mind that were not addressed, regarding the parallel conversations. So I went through a boot camp, and they suggested to not open a round and just have a bunch of try to concentrate a bunch of conversations so that you can get interest and soft circled interest in 150% of your intended round, and then open it and close it in a limited time period. So that's what generates a FOMO. What I've struggled with is, it's been it's an odd industry. I can't, venture investors don't understand my industry well. And the second, just a very tactical thing, is email tracker, similar to DocSend, but email tracker, it shows how many opens someone's, and that it is an indicator of interest. And then in terms of, the dilution versus how much versus all of that, I've tried to look at what are the investors' goals. For example, I met yesterday at All in All a new fund manager who's had a great track record, and her fund size 33 million. So you can assume that for every investment there needs to be some opportunity to return 3x their fund, so 100 million. So if their goal is 10% of the company at exit, then that allows you to back up, reverse calculate how to address that fund, that investor with the amount of the investment versus the dilution versus the percentage of company, right? based on your company's potential. And then no one ever talks about QSBS.
Yeah.
And qualified small business stock, for the first $1 million, the after-tax effect on an angel is better than a charitable contribution.
Yeah, there's a few service providers that are out there talking about QSBS, but I agree it's probably not talked about enough. And I think as far as, when you're talking to VCs, you're not going to sell them on a 3x exit. You want to show that you can give them a 10x return.
No, I'm talking about if your company is the only one standing out of their portfolio, they need to have their entire fund be returned by your company. And
right.
So if there are 30 investments, and yours is the last one standing, it's got to have that potential, and that allows you to back up,
right.
Yeah. So.
Yeah. I mean, that's why, the VC model is in question. If there's only one company that they're relying on getting all their returns from, how are they choosing that company? So yeah, it's super interesting. All right, I have to wrap this up. We're way over, but love to continue this conversation. But thank you all for coming.